Hello, everyone, and welcome to today's webinar. My name is Anu Sood, and I'm the Director of Marketing at CaseWare RCM and today's moderator. Today's presentation is a bit different. We recently hosted a webinar on the money laundering and fraud risks of wire transfers. And we had so many questions from the audience that we have to have an overflow session. So today we will cover the questions that were not answered in the previous two webinars. Now, if you weren't able to attend the previous sessions, don't worry. You'll find that the questions and answers are insightful and are relevant to you since they are questions from your peers. So Laurie has a 35-year career spanning the fields of accounting, finance, risk management, and regulatory compliance. Most recently, she served as a Director of Compliance for CoBank ACB, a $145 billion farm credit system institution, where she developed and managed the bank's AML, fraud, and economic sanctions compliance programs. She holds CAMS designation as well as CAMS audit specialization. And she helped found the ACAMS Colorado chapter, serving as its executive board chair and programs director. And with that, I'd like to hand over the presentation to Laurie.
Well, thanks, Anu. And it's great to be here, and I just want to welcome everyone again to this Q&A forum on wire transfers. So we've organized the questions into categories, and I'm going to do my best to answer them. So we'll just jump right into it here with our first group of questions about FedWire and also its comparison to other funds transfer systems that we cover in the webinar. So why would a bank not be registered with all three EFT systems, FedWire, CHIPS, and SWIFT? Why do all banks not participate in FedWire? Is it due to fees? Well, the funds transfer system or systems a financial institution chooses depends on a number of things. It could be the nature of their client base or products and services that they offer. Now, my bank, CoBank, only used FedWire. Now, CoBank does use SWIFT, but only for export letters of credit and general interbank communications with foreign banks, not for payments. Now, when it comes to CHIPS, I kind of think of CHIPS as a club that's reserved for the biggest of the big players. And after all, there are only about 50 participants in CHIPS. So to answer the second question, a financial institution might not participate in FedWire, either because they don't have a big demand for wire transfers, or it could be because they're a non-bank financial institution that's not eligible for a Fed account. So think finance companies, securities broker-dealers, or life insurance companies, for example. Now, with respect to the question about FedWire fees, here's the most recent, it's FedWire's 2020 fee schedule. So you can see it's based on the number of transfers processed per month. The more you do, the cheaper it is. And also there's an incentive discount based on volume averaged over a 5-year period. Now, CoBank processed about 15,000 wires per day. And let's assume they got the incentive discount. So at 15,000 wires a day, approximately 20 business days in a month makes 300,000 wires per month. At 3 cents per wire is $9,000 per month. Then there's the monthly participation fee and a 14 cents per wire surcharge for any wire over 10 million, which CoBank had a lot of. I'd guess 15 to 20% of our wires were over 10 million. So let's say 60,000 wires a month over 10 million, and that's another $9,600. So probably $18,000 to $20,000 a month for FedWire. Now, SWIFT and CHIPS don't publicly share their fee schedules, but as I recall, CoBank, which again didn't do payments through SWIFT, just letters of credit, usually paid around $15,000 to $20,000 a quarter to SWIFT. So that kind of gives you an idea. And so obviously fees can certainly be a consideration in a financial institution's deciding what they'll use for wire transfers, whether they initiate them directly or just use a correspondent if that's more cost effective.
So the fees really start to add up, don't they?
Yeah, definitely.
Yeah. So is the address mandatory for a FedWire?
Well, no. Fedwire doesn't currently require any address information for any party to a funds transfer. And as we talked about in the webinar, the Fedwire format does provide 3 lines of free-form text for addresses to be entered, but like I said, these are entirely optional.
Okay. Okay, now is instant cash considered to be a wire transfer?
You know, I wasn't exactly sure what is meant by instant cash, so I researched this a little and I found that it tends to be a branding or a product name given to some different financial services like cash advances on credit cards or payday loans or short-term consumer loans, and then some types of funds transfers by MSBs. So the only one of these that would be considered a wire transfer would be an actual wire transfer initiated by an MSB. Now, MSBs can also move money by ACH, but ACH is not a wire transfer. So to really answer this question, you need to know what the underlying service is that's being called instant cash.
So is it that the service that actually does the transfer? Is that what you mean?
Yeah. So what's the underlying transaction that's actually occurring to give you instant cash? Yeah.
Can a sender remit funds with an ABA number for one institution and a SWIFT code for another in the same transaction?
Yes, you can, but both the Fedwire and the SWIFT systems would come into play. Bottom line is, for whatever funds transfer system you're using, you have to use their bank identifiers. So in other words, a direct transfer with no intermediaries, for Fedwire, you have to use both banks' Fed routing numbers or ABA numbers.
Okay.
And then for SWIFT, you'd use both banks' SWIFT BIC codes. But when the 2 banks aren't on the same system, then you need an intermediary that is. And your payment instruction would provide, for example, the Fed RTN of the originator's bank and that of the intermediary bank, and then the SWIFT BIC of the beneficiary's bank. And all that information would be on the payment instruction because it should show the whole chain from start to finish.
Okay. The next section, we certainly had a number of questions, and the FinCEN travel rule. So does the travel rule apply to bank-initiated transfer for bank expenses?
Well, the answer to that depends on who the bank is paying for these expenses. If they're paying any one of these types of entities, then no, they don't have to comply with the travel rule for that transfer. But if they're paying Office Depot, then yes, they would need to comply. And as a side note here that we didn't really touch on in the webinar is that a bank can be both the originator and the originator's bank on a wire transfer, just like in this particular example.
Interesting.
Yeah.
What is meant by the statement that the travel rule doesn't require full information?
Okay, well, what this means is that the travel rule does not require any information about the beneficiary on a funds transfer, meaning their name, their address, or their account number. What the rule says is that if your originator gives you any of this information, then you must include it. But if you don't ask and they don't tell, none of that beneficiary information goes on the wire.
What happens to the data collected pursuant to the travel rule? For example, is it reported, and to whom?
Well, data that's collected by financial institutions pursuant to the travel rule isn't automatically reported to anybody. Instead, financial institutions are required to retain or store the data for 5 years from the date of the transaction. Then you have to be able to retrieve it if requested by law enforcement or a regulator. Now, if you're the originating bank, you have to be able to retrieve specific wire transfer records either by the originator's name or by their account number if they're a customer. And if you're the beneficiary's bank, you have to be able to retrieve the records by the recipient's name, even though that name isn't required by the travel rule, which is kind of ironic, don't you think? And you have to provide whatever wire transfer records they request within 120 hours of receiving the request. So make sure your bank's data retention policies ensure all your wire transfer records are kept for at least 5 years.
So do they need to do something special in terms of their compliance, like documenting their compliance program to sort of make up for this, to collect the right information?
I'm not sure I understand your question, Anu.
Okay. Well, you said that it may not, they are required to store it, but they don't, they're not required to collect it.
Well, store it, yeah. Collect it and store it.
Or collect it and store it, okay.
Yeah, yeah.
I'm sorry, I misunderstood there.
Oh,
okay.
No worries.
No, travel rule address related questions. So the address question really came up many times, didn't it? So is a P.O. box considered a valid address?
Well, this is a perennial question that I wish FinCEN would just clarify for posterity, but the answer is that there is no requirement in the travel rule that an originator's address may not be a P.O. box. Of course, the travel rule has no requirement around the beneficiary addresses either way, so I suppose a P.O. box would be fine for them as well. The regulations just state that you're supposed to use the address you have on file for your customer. Now, many banks take a risk-based approach and just require a physical address for wire transfers, which from a KYC perspective, they should already have. Now, sometimes there's nothing other than a P.O. box for the address, and I can speak to that from experience, as a large portion of my bank's clients were in rural areas where that's all you've got.
Yes.
Yeah. Now, one other thing about P.O. box addresses is that you cannot use them on a cash transaction report. But the CTR regulation and the travel rule are two different things. So that's undoubtedly one source of the confusion.
Is the ODFI required to input the recipient's address?
So ODFI is a term that's actually used with ACH, not wires, but it stands for Originating Depository Financial Institution. But let's assume we're talking about wire transfers here. And the answer is only if the originator provides it to you do you need to include the beneficiary's address.
So here's an MSB question. So for an MSB as originator's bank, is the sender required to provide a home address, or is a care of address, for example, work address, acceptable?
Okay, so I'm going to make an assumption here that since the question refers to an MSB, what they're asking about is a wire transfer by a non-customer, since MSBs don't maintain accounts for their clients. And I'm going to go over here the travel rule specifics around non-customer funds transfers. First, if the funds transfer order is made in person by the originator, you have to verify their identity, and you must obtain and retain a record of that person's name and address, the type and number of their ID, as well as their tax ID number. Now, if your funds transfer is being made by someone other than the originator, you have to verify and keep a record of the identity of that person who's there doing it, their name, address, ID, and tax ID number. But you also have to obtain the tax ID number of the actual originator, so Social Security number or employer ID number. If the person placing the order says they don't know this, then you're just supposed to make a record of that fact. But I would say, to specifically answer that one question, I would not let someone use an address that's not their home address.
So do the travel rule exemptions apply to cryptocurrency transfers, specifically when the sender and recipient are the same person?
That's a great question. And there's a lot coming up now about cryptocurrency and travel rule. The crypto exchanges in the U.S. are considered money service businesses, and therefore they must comply with the travel rule. So I think it's safe to say that the exemption from the travel rule requirements when the sender and receiver are the same person would apply to a cryptocurrency transfer the same as a wire transfer.
Okay. Same rules.
Mm-hmm.
Okay, very good. Okay, so we had a few SWIFT questions, and so I think, Laurie, we had so many SWIFT questions that we decided that we're going to try and put a webinar just on SWIFT. But until we get to that point, we thought we would answer a few of the questions that came in, at least to keep people going. So one of the first questions that came in is, what is the difference between SWIFT MT100 series and MT202?
Well, I'm going to answer both these questions
Okay.
in a little more detail. So remember, first of all, that SWIFT funds transfers are just messages. There's no real-time settlement funds as we have with FedWire. So banks that have correspondent relationships each have a due to/due from account on their books for each of their correspondents to keep track of funds that are sent and received between them. And that correspondent relationship is very important because establishing one is a pretty big deal. So not all banks may need to someday send funds to one another. Not all banks that may need to someday send funds to one another need to have correspondent relationships. So they just work through banks that do. But first, let's define the two primary message types, the MT100 series and the MT202 or MT202 COV, which are called cover payment messages. The MT100 series is what SWIFT calls customer payments and checks. And there are actually 21 different types in the series, all starting with 1. So 101, 103, all the way up to 199. And I've listed just some of the more frequent ones here. The most commonly used one is MT103, which is a single customer credit transfer. So just remember, the 100 series are all messages relating to customer payments. Okay, so now let's talk about the MT202s. There are actually 17 different message types in the 200 series, which are all for financial institution transfers, or think of them as bank-to-bank transfers. And again, these are just some of them. We're going to focus on the 202 and the 202 COV. So to understand these, let's look at an example, and because I just love pictures. Okay, so here's the background on this funds transfer we've got illustrated here. The originator's bank is Mitsubishi in Japan on the left, and the beneficiary's bank is Asa Banka in Bosnia. And the payment instructions say the beneficiary needs to be paid in local currency, which is the Bosnian convertible mark, abbreviated BAM. Now, Mitsubishi and Asa Banka don't have a correspondent relationship. So they need to use one or more intermediary banks with whom each of them does have a correspondent relationship, but everybody's on the SWIFT network. So what will happen is that Mitsubishi will send an MT103 single customer credit transfer message to Asa Banka telling them, hey, our customer's sending you some money and you need to pay him 1,000 BAM. And if you listen to the webinar, you'll remember the MT103 has all the details of the originator and beneficiary on it. Now, in this instance, Asa Banka responds back with an MT199, which is a free-form message, saying, okay, that's cool, then we want to be reimbursed in US dollars for this transfer, which the equivalent is 576 US dollars, at least as of last week. But since Mitsubishi and Asa don't have correspondent accounts, they can't actually post due to, due from entries for each other. Instead, they have to use intermediaries. So Mitsubishi's correspondent for US dollar transfers is Wells, and Asa's is Chase. And Wells and Chase obviously have correspondent accounts. They're big banks. So the message that's going to go through the intermediary banks is what's called a cover payment, meaning I like to think of it as, hey, cover this funds transfer for me and I'll pay you back later. The 103 between Mitsubishi and Asa is really just an instruction or a heads up, if you will. Now, it's important to note that I've shown here that an MT202 COV or COV message type is being used. Now, this message type didn't come around until about 2009. Previously, all we had was the 202, which is just a standard interbank transfer, quote, for a bank's own account. The thing with a 202 is that it has no information about any originator or beneficiary on a customer transfer. So when it was used as a cover payment message, this led to all kinds of AML and sanctions compliance issues because the intermediary banks couldn't do any screening, either for sanctions violations or suspicious activity. And an originating bank could intentionally use the cover method, meaning a 202 and a 103, to hide the true originator and beneficiary of the transfer from the intermediary banks. This was an especially big deal for U.S. intermediary banks, where the originating and beneficiary banks were looking to avoid any OFAC sanctions issues. So that's why in 2009, SWIFT came up with this MT202 COV message, which has all the originator and beneficiary information for the underlying transaction on it. Now, banks are to now use this message type when they're covering a customer payment through an intermediary. Using the regular 202 for a cover payment is a big no-no, and intermediary banks should be very much aware of this. Now I'm going to show you the cover payment from the perspective of the accounting entries, also because I'm an old bean counter and I need to see T accounts. So remember that Mitsubishi is the originator's bank. When they send the 202 COV message to Wells, their accounting entry will be to debit their customer's account and credit due to Wells. Wells gets the message and sees that they need to pass this on to Chase. So they'll make an entry to debit due from Mitsubishi and credit due to Chase. When Chase sends the cover payment message to the beneficiary bank, Alessa, their entry will be to debit due from Wells and credit due to Alessa. And then Alessa will debit due from Chase and credit their customer's account in US dollars converted to BAMs. So that's just a very basic illustration of a SWIFT cover payment in the 202 and 202 COV types.
So before we get to this, and I don't know if this is applicable, someone asked, are SWIFT rules the same and applicable in every country?
Yes.
Okay.
The SWIFT network establishes its own rules.
Okay.
So anyone that's a member bank of it would have to apply.
Okay, very good.
Mm-hmm.
So can we send a SWIFT MT99? They get 39999 for client payments? Yes.
Yeah, all the SWIFT message types are 3 numbers. And then MT stands for message type. So, well, the answer to this is no. An MT999 is not a form of payment. It's actually a specific type of communication that's requesting proof of funds on deposit. So maybe before cashing a check, for instance. But it definitely cannot be used for a funds transfer.
Okay. So is a SWIFT funds transfer similar to when a U.S. bank uses a correspondent bank to process a Fed wire transfer?
Well, yes, conceptually, because the originating bank and the correspondent are making accounting entries on their books to record the funds that the correspondent is going to transmit and settle by FedWire. There just isn't a formal messaging system like SWIFT for the 2 U.S. banks to communicate this. It would just be arranged between them in some manner that they've determined is most effective for them.
Great. What is SWIFT manual download?
Well, this is really interesting, and I had to do some digging on this as I'd never heard that term before. And maybe the reason why is because what I found is that it's an illegitimate way to transfer funds by bypassing bank controls. And it's usually a scam. Now, I found lots of online public forums where people were looking for senders or receivers of MT103 messages for, quote, manual download, or they're promoting themselves as somebody who could do this. Now, from what I can gather, it's supposed to work like this. An MT103 and an MT202, not a COV, and just MT202, are uploaded to SWIFT as normal. But an employee at the sending bank and an employee at the receiving bank are supposed to privately communicate to pass on the various system codes that are needed to complete the transaction. And then using these codes, the receiving bank employee goes into SWIFT, finds the messages, downloads them, enters the codes, and then the transaction completes. But one important part of the process is that the receiving bank employee is supposed to shut down all applications and systems used by the bank and only use the SWIFT system. So in other words, they're bypassing any fraud monitoring, sanction screening, or AML monitoring software. Now, I found a blog post by a financial writer who summed it up like this. He said, "The whole purpose of SWIFT manual download is simple. People want a way to send funds undetected away from the monetary authority's eyes and avoid paying taxes. All they need are willing and corrupt bank employees on both sides to facilitate the transaction, turn off all monitoring software, download the message, type in the codes, and the funds will post to the receiver's account." And now that's probably for a fee, which is where I'm guessing the scam comes in and the transaction never actually takes place.
Interesting.
Yeah. So avoid SWIFT manual download at all costs.
Okay.
Yeah.
So let's talk about correspondent banks. So that came up a few times during the wire transfer, is a correspondent bank always considered an intermediary bank?
Well, I have kind of a long-winded answer to this, but the word correspondent can refer to a bank, to an account, or to a relationship between two banks. Now, the standard definition of a correspondent bank is one that provides services to another bank, in essence, providing that bank's customers access to the financial system. And although you don't hear this term used very much, the correct word for the bank to whom services are being provided is called the respondent bank. So the relationship between the correspondent and the respondent is known as a correspondent relationship. And the underlying account on each bank's books for that relationship is generically called a correspondent account. And now, because of our central bank in the U.S., the Federal Reserve, most banks don't need to have correspondent relationships with other U.S. banks because the Fed provides the message and the settlement. But correspondent accounts and relationships are essential in the rest of the world to move money. So a correspondent bank is clearly the intermediary bank on a funds transfer on behalf of its respondent. But banks may have correspondent relationships for things other than wire transfers, specifically through SWIFT. For example, as I mentioned early on, CoBank had many correspondent relationships with foreign banks for processing and settlement of export letters of credit. No funds transfers, but still considered a correspondent relationship.
Okay, so how far must compliance go for wire transfers conducted on my correspondent's customers?
So there is no easy answer to this question, but it starts with the correspondent, or more correctly, the respondent bank itself, and how much due diligence you've done before entering into a relationship with that bank. You should be, first and foremost, assessing the quality of their AML program. And this is commonly done via a questionnaire. The Wolfsburg Group developed one many years ago, and a lot of banks use it, or they take the Wolfsburg Group questionnaire and then add on to it with their own questions. You should also have an assessment of that bank's general nature of expected transaction activity to and from what countries, types of customers like commercial, consumer, government, etc. And this way you'd have a general idea of what should be normal activity through the respondent's account on behalf of their customers. then you monitor that activity for any higher risk red flags. Now, obviously, you can't monitor to quite the extent you could on your own customers because you haven't done the KYC on the respondent's customers, but you can still monitor for patterns from the same originators, same beneficiaries, higher risk countries, and so forth. So really, the level of monitoring and scrutiny on wire transfers by your respondent's customers is based on your risk assessment of that bank itself and the nature of its customer base. So in other words, that good old-fashioned risk-based approach.
Which is the segue to the next question.
Segue to the next question, yes.
Yeah, is it prudent for a bank to place sole reliance on correspondent screening processes for transactions?
Yeah, so definitely a related question. And again, my answer here is it's a risk-based approach. But when you say screening, that could mean either for suspicious activity monitoring, or it could mean sanction screening. Now, with respect to sanction screening, specifically OFAC, there's no way that you're allowed to rely on somebody else to ensure you're complying with the sanctions. So you should be OFAC screening your respondents' customer transactions, absolutely. But suspicious activity monitoring would be along the lines of what I just described for the previous question.
So, Laurie, before you go to the next question, I think the question that just came in is, I think you just touched on it, but let's just make sure. Can you please guide ultimate responsibility, like who the ultimate responsibility lies, whether your originator bank or correspondent bank during SWIFT payments? Let me, yeah.
So the originator's bank is, I guess in general terms, I could answer that. The originator's bank is, the onus is on them, not any intermediary banks.
Okay.
And to make sure all the information is there that is supposed to be there, and that they've done due diligence on their customer. For OFAC screening or sanction screening, everybody in the chain is responsible.
Okay.
Because if you touch that transaction, you want to make sure that you're not violating a sanction by processing a payment or something else on behalf of a sanctioned party.
And that's just not for SWIFT. That's for any transaction, correct?
Any transaction. Yeah.
Any transaction. So the question was a little tough to read, but basically every originator, the originator bank is responsible for, I guess, collecting the appropriate information. Is that correct? That's
correct, yes.
Okay. If, the person, and hopefully we answer that that person's question, and if not, let us know. All right, so can a correspondent bank force its client's correspondent, a community bank, to file a SAR based on the observation of potentially suspicious activity?
Well, no. Whether or not your respondent chooses to file a SAR is not your responsibility. You can certainly file a SAR on the activity, and you can and probably should also share your concerns about the activity with the other bank. But your decision to file a SAR and their decision to file a SAR is completely under the purview of each bank, and neither one should know that the other one filed a SAR.
Okay, so you shouldn't be discussing it.
Yeah, you can discuss suspicious activity and the nature of transactions, but you should never reveal that you've actually filed a SAR.
Okay, very good. And I think that was one of the questions in the SAR webinar, right? How much do you disclose?
Right.
So coming to fraud, and I'm sure there's a lot of questions in this one. So could a bank customer be a perpetrator of fraud?
Absolutely. This would be a form of illegal activity being perpetrated by the customer through their bank account. And, if you've been around AML for a while, you may remember a big case with one of the major U.S. banks that shall remain nameless, that had accounts for third-party payment processors who were working with criminals to defraud customers, and all the illegally collected funds were being deposited into the processors' accounts. And the bank looked the other way for a long time on this because they were making so much money on fees with these accounts. They were using what are called remotely created checks and to defraud consumers. And if a lot of times those would get rejected by the consumer's bank. And so that came up as a return check. So there's a $50 bad check fee for every single one of these. And so the bank was making tons of money on these return check fees on these accounts. And they ended up, it was uncovered and the bank had to pay a massive amount of restitution to the consumers and pay a fine and all that. So yes, definitely you can have a customer committing fraud through your bank.
Okay. So this is always a favorite question.
Mm-hmm.
They want, I'd love to hear more real life examples of wire related fraud cases. They're very instructive.
Okay. I have a ton of stories, but I'll tell you about another case that I recall that was kind of interesting, and it involved a rather clever social engineering scam. So my bank had a customer that was a winery, and they had this little retail store at their vineyard where you could buy their wine. A fraudster emailed the winery posing as a customer and said that they wanted to place a very large order for wine. And they said, well, we'll pay by credit card, but we want our own shipping company to pick up the wine and ship it to us. So they told the winery, charge our credit card for the wine plus the shipping, which we've calculated will be $2,500. And then they instructed the winery to then wire the $2,500 for the shipping cost to some third party, supposedly the shipping company. And you may already see where I'm going with this, but so the winery charges the credit card for the price of the wine plus $2,500 for the shipping, and then turns around and forwards the $2,500 by wire transfer to this third party. The next day, the fraudster emails again and says, hey, we want more wine, so let's do another order using the same process. And the winery does the same thing, charges the credit card and sends another $2,500 to the third party. On the third day, guess what? Well, the credit card that was used comes up as stolen, and the charges that the winery made to it get reversed. Now, unfortunately, they are now out $5,000 for the two payments to the fictitious shipping company. And the money was unrecoverable, but on the bright side, they still had the wine. Nobody ever came to pick it up.
So, I mean, this is, there's just so many ways for things to go wrong, right? So I think
so many ways, yes.
And so these, so people always find these helpful. So, so I guess one question that came in does, I guess if I understand the question, they were failing to understand the link from the story to wire transfers.
Oh, so this was a case of, we talked about social engineering a lot as it relates to fraud, and how this was, a wire transfer was the mechanism by which social engineering took place, and they stole $5,000 from this customer.
Very good. Yeah, and it's not, and if I understand correctly, it's sometimes not just wire transfer. Wire transfer fraud doesn't always happen in isolation. If I understood your story as well, you had credit card fraud as well.
Yeah, and it's really one of the key points we made in the webinar was that wire transfers are the mechanism by which fraud takes place. In about 75% of all fraud cases. That was a study that was done a number of years ago. 75% of all frauds involve wire transfers.
Okay.
So, and unfortunately, because of the irrevocable nature and finality of wire transfers, that this customer could not get their money back.
Okay. So I think one question that came in, does the banks offer any protection in the event that employee of banks is tricked into transferring money out of someone's account?
That could be, because that would mean that the bank did not have good controls.
Okay.
appropriate identity verification controls and so forth.
Okay, so it really depends on the case.
Mm-hmm.
Yeah, okay, very good. So what if the recipient of a fraudulent wire is also a victim of identity theft? So the person never opened the account. This was determined by speaking with the other bank security team.
So what I'm getting from this is that an account was fraudulently opened in the name of an identity theft victim on one bank, and then a fraudulent wire transfer was sent to them from another bank. Well, this is not good,
Yes.
obviously. The bank where the fraudulent account was opened could be in some serious trouble for lack of controls over account opening, CIP, KYC, right? And both banks should be filing a SAR for what happened, referencing each other in the narrative. And that's all I can really say about this question.
Okay.
It's kind of a scary situation, but.
Yeah, and it comes back to our statement that, the fraud, there's usually layers of fraud to
Absolutely.
yeah, exactly. Must a business email compromise SAR be filed if the fraud was not successful?
Absolutely. Most of our BEC frauds were not successful because of, dare I say, our great detection and intervention procedures and our amazing fraud analysts. But if we had information that was of any value to law enforcement, which we usually did with a BEC scam, then we would file a SAR. For example, you have the email address of the where the fraudulent message came from, and the payment instruction details of who the money was going to. Those are very valuable to law enforcement, and we would get those from our customer. They would share those with us so that we could file a SAR. And so, yes, please file a SAR if you have good information.
Okay. So can a bank be liable in a business email compromise scam for not picking up the fraudulent wire transfer?
I doubt it. And since we didn't clarify this with the last question, I'll just clarify that a business email compromise scam is where a fraudster is using email to impersonate a high-level company employee and instructing a lower-level employee to initiate some kind of transaction, almost always a wire. So in the early days of malware, there were several court cases brought against banks for not detecting fraudulent transactions that were initiated by hackers without the customer's knowledge. But the beauty of social engineering scams like BEC is that the customer themselves is willingly entering or requesting the transaction. So it's very unlikely that a customer could prevail in court against their bank for not detecting this. And that's also why we always spoke to customers on a recorded line when we were calling them to verify the validity of a transaction. In the case example I gave earlier about the winery, our fraud monitoring didn't pick up anything suspicious about those two $2,500 wires. And our customer fortunately acknowledged this was their own fault for falling for this.
Yeah. So I think before we head out, and I know we got lots of questions, so we're a little tight here. I don't know if it's possible. Can you delve into shell companies located in the Caribbean islands? Are there any tips, tricks to spot suspicious wires being sent there?
Only if if that's out of pattern for the customer, for one. The explanation or lack thereof of the purpose of the wire that is on the wire or not on the wire. And definitely asking if it's not in pattern, asking your customer about the purpose of it.
So some of the same things that you do for other wires.
Yeah, because it could be that your customer may be the victim of a scam.
Yeah.
Or it could be that they're trying to move money. They're trying to launder money. So it could go either way. Or it could be perfectly legitimate for some reason. So you really have to ask.
Okay, very good. So now we get into, reporting suspicious activities, detecting suspicious activities. So the first question is, if a client receives multiple 25,000 international wire into their account from the same originating bank, is that suspicious?
Well, maybe. It just depends on a lot of things. One, as I was just talking about, is this normal or typical activity for this customer? And where are the funds coming from? And can you find any information on the originator? Is the originator located in the same country as the sending bank? So you really need to dig deeper into the details to decide if it's out of pattern for that customer and if it has enough odd characteristics to deem it suspicious. And as I just said as well, you should ask the customer what's the purpose of these transactions and see what they say. Their response might give you further concern and make you decide to file a SAR, or then again, you may discover that it's perfectly legitimate.
Normal activity, yeah, exactly. Mm-hmm. So referring to the recent money laundering incidents that occurred in Sweden, so it's the Swedbank and Denmark, Danske Bank, what were the one or two biggest red flags that were ignored? So these, and in this case, those countries are not financial secrecy locations, nor were many of the transactions destined for secrecy havens.
Well, here's what I've gleaned from these two cases, which were actually interrelated. Both involved serious deficiencies in the bank's AML programs. They were banking high-risk customers with no real KYC performed and deliberate withholding of information from authorities even. But the money laundering actually occurred through both of these banks' Estonian subsidiaries, so not in Sweden or Denmark, although that is where the parent banks are based. And Estonia is a high-risk country for money laundering. The Danske Bank case has been called the largest AML scandal in history so far, I guess. Danske, the parent company, initiated an internal investigation into the potential money laundering that was occurring through its Estonia subsidiary. And they found that the Estonia branch, if you will, had allegedly processed $234 billion in suspicious transactions by thousands of high-risk, non-resident, primarily Russian, business entities and individual customers from 2007 to 2015. Now, Swedbank's Estonia subsidiary just happened to be the largest bank operating in Estonia. And it was discovered that Swedbank Estonia allegedly allowed suspicious transactions to pass through it from Danske Estonia. So an investigation was launched into Swedbank Estonia as well. And it was found that the bank had allegedly processed suspicious transfers of up to $22 billion per year between 2010 and 2016 from, again, mostly Russian non-residents. And the United States is also investigating deliberate OFAC sanctions violations by Swedbank Estonia on about 4.8 million of transactions, million dollars. Yeah. Wow. So just like Danske Estonia, Swedbank Estonia had a high volume of high-risk entities and individuals as clients whose accounts were opened without any proper identification or KYC. And some of these clients were even later found to be associated with prior money laundering cases. So both these cases hinged on non-existent KYC, probably deliberately, but we don't really know for sure, in opening accounts for Russian entities and individuals who were not domiciled in or residents of Estonia, and complete disregard for any real due diligence or identification, beneficial owners, or even flagging prior involvement in money laundering. So there you have it.
Okay. So is the beneficiary's name and account is a business? Okay, if the beneficiary's name and account is a business, but beneficiary's address is residential, would this be a red flag?
Well, again, maybe. There are lots of small businesses that operate out of the owner's home, or the, quote, headquarters are the owner's home, but the actual business is conducted, say, at their client's location, like an interior decorator, for example. So you can look up the beneficiary company on their state's Secretary of State website and check their address. If it matches what's on the wire, then I'd say it's okay. Now, of course, I'm assuming that this is a U.S. party. So if you don't find a match, then ask your originator. This could be a fraud scam, so ask them more about the transaction.
Okay, very good. So when you're asking about transaction, actually one person asked, do most banks ask for purpose of wire for all outgoing wires?
Not typically.
Okay.
It just depends, I would think, on that bank's policy. Yeah.
It probably also, there's probably many factors to consider, but certainly I think the amount would be a consideration of frequency.
Mm-hmm. And whether they're placing the wire transfer order in person versus doing it through an online banking system.
Yeah. Okay. In your experience, have wires to high-risk countries result in more investigations and SAR filings?
I wouldn't say more investigations and SAR filings, but there certainly were a number of SARs where the country, and in my case, these were mostly incoming wires, not outgoing, the country was one of several suspicious factors. But really, foreign wires in general that were either out of pattern for the customer, say from countries like China, Cambodia, Libya, and Panama, where we knew the customer did not do any business. Those are the biggest red flags to us.
Okay. So are financial secrecy countries the same as those on the FATF countries list?
Well, not necessarily.
Yeah.
The FATF identifies countries that have a significant AML regulatory deficiencies. Now, there's no really global agreed upon definition of what is a financial secrecy country, but there is an organization called the Tax Justice Network, and they define a financial secrecy country as one that enables people or entities to escape or undermine the laws, rules, and regulations of other countries, using secrecy as a primary tool, and I think that's a pretty fair definition. Every year, the Tax Justice Network scores 133 countries in what they call the Financial Secrecy Index. The countries with the highest scores for 2020 are the Maldives, Angola, Bolivia, and Jordan. And you can see the whole list and all the scores on their website, which is taxjustice.net.
And maybe they could also watch our recent webinar on calculating geographic risk.
Mm-hmm, absolutely. Yeah, we talk about the Tax Justice Network there.
And the corruption, the corruption indexes and all that. I think those are all worth considering evaluating when you're looking at risk associated with certain countries.
Mm-hmm.
What red flags can you look for to identify potential money laundering if the ordering customer is submitting all required information?
Really, here, again, you're looking for out-of-pattern activity. Is the nature of the wire unusual for that customer? And what about the beneficiary? Are they unusual? It's almost always not about the information they haven't provided, because if they're doing something shady, they want to make sure the bank won't come back to them with any questions. So they make sure every T is crossed. It's what's in that information that matters.
Great. And I'm sort of looking at the time and I'm going, all right, we got a few more questions to get through here. So some countries are originating centers of many frauds. How can we identify those countries and activities?
Just quick answer here. I just suggest doing some research. You can look at the FinCEN advisories, look at the FATF country reports, the U.S. State Department reports, and then just good old Google can tell you a lot.
Okay. Can a bank return wired funds to the sender based on a serious adverse news about alleged illegal activities, crimes, but there's no conviction yet?
So I'm interpreting this question to mean that you're the receiving bank and you've done some research on the sender of a wire transfer. Now, unless there's a sanctions violation, you must accept that wire. You don't have either the responsibility or the authority to return it based on negative news about the sender. But most certainly you would file a SAR and you want to take a really close look at your customer who was the recipient of those funds.
Very good. So a couple of OFAC questions here. When did OFAC originate?
So OFAC, as we know it today, was created in December of 1950 after China got into the Korean War. And our president at the time, who we used to all give him hell, Harry Truman, he declared a national emergency, and he froze all the Chinese and North Korean assets that were under U.S. jurisdiction.
Okay. So, and I know we get this often. What are the foreign counterparts to OFAC?
Well, the two main counterparts are the United Nations and the European Union sanctions programs. And now many of these overlap with OFAC sanctions for obvious reasons, but the EU especially has imposed its own sanctions outside of those of the UN or OFAC. And the biggest difference between OFAC and the UN or EU is that OFAC sanctions are dictated entirely by one country, the United States, and in the vast majority of cases, the President of the United States through executive order. But in comparison, the UN and the EU sanctions have to be voted on by representatives of their member countries, so it's a little more democratic.
Very good. So this is, I think, someone's specific case, but I think it's just worth looking at. And I think this is a case where we talk about sometimes within organizations, there's different opinions. So sanction screening generates a hit on the beneficiary name, which is a 100% match with an SDN, who's also a PEP. The dollar is as small as $100, 100 US dollars. As an AML analyst, I don't see any AML terrorist financing risk, but sanction risks is low. Should I hold the transaction for more checks or release the payment considering the low risk?
Well, this was a little bit confusing, but first of all, there's no minimum dollar threshold on OFAC sanctions violations. So if you've got a 100% match to a specially designated national, you need to block, in other words, freeze those funds and report it to OFAC, and you would not process the transaction. You would also need to tell your originator that their funds are blocked and that you're not going to process their payment because of an OFAC violation. So it's not the same secrecy rules as with a SAR. So based on the details here, it looks like there wasn't any apparent terrorist financing involved, and given the dollar amount, a SAR filing wouldn't be required. But you'll want to take a much closer look at your client, especially with the SDN also being a PEP. This low dollar transaction could have been a test to see if the bank would catch it. So definitely do a little more digging.
Okay. So what is the minimum information that you need to obtain from your customer in order to validate and document the transactions?
Now, here I'm assuming we're talking about when you're investigating a suspicious transaction from a money laundering, not a fraud perspective, and what you'd ask your customer to provide to validate it. If you thought it was fraudulent, you'd just ask the customer to confirm it's legitimate, preferably on a recorded line. But on a suspicious transaction, what you ask for depends on the nature of the transaction. If it's a commercial client, you'd ask for something to substantiate the business purpose of the payment. And that's incoming or outgoing, because there shouldn't be anything but business-related transactions on a commercial account. If it's a consumer account, then you need to first research the beneficiary or the sender, if it's incoming, and see if you can find anything. And then you decide what to ask for based on that.
Very good. So we're over time at this point. I think at this point, if there were some additional questions that came in, what we'll do is we'll take a look at them, and what we'll do is we'll try and answer them and put the ones that we can answer. We'll put them on our blog, as well as a link to the recording, so that you can see those questions and answers. So with that, I would like to thank everybody who joined us again for this webinar, and Laurie for providing the time to answer everybody's questions. I hope you found this useful, and this now concludes our presentation. I hope everyone has a great day.